Welcome to the deep dive. We take stacks of sources, pull out the key insights, and, well, deliver them straight to you. Today, we're plunging into a story that starts with someone calling himself a guardian of the pension industry and, maybe astonishingly, ends with his bankruptcy.
Yeah, it's quite the arc.
It really is. It's a story about trust, these incredibly complex financial schemes, and sort of what happens when the lines blur between protecting assets and, well, actually participating in moving them around.
Microphoning.
Our sources for this deep dive are some carefully selected excerpts from Stephen Knight's Gibraltar Pension Downfall.
Right.
These documents detail the intricate layers of a financial collapse that unfortunately left many investors with pretty heavy losses.
Yeah, devastating for some.
Our mission is to understand exactly how Stephen Knight, who was once this celebrated reformer or prominent figure, how he transitioned to facing serious allegations and ultimately his own financial ruin. We want to get into not just the sequence, but the mechanics behind it all.
And what's really fascinating here, I think, and crucial for you listening, is how the whole narrative shifts.
Yeah.
You've got this individual presenting himself as an industry leader.
Yeah.
A protector, even.
Right, the guardian.
Exactly. And then he becomes this central figure in schemes that, frankly, raise huge questions about financial oversight, about accountability.
Okay.
So we'll be connecting the dots, looking at the different companies, the actions, trying to see not just what happened, but why. And maybe why it challenges how we think about financial safeguards. You know, where can you actually place your trust?
Okay, so let's start with Stephen Knight himself. He founded Castle Trust and Management Services, CTMS, and positioned it as a, quote, trustworthy player in the offshore pensions world. He didn't just operate there. He actively styled himself as a guardian of Gibraltar's pension industry.
Quite the title.
Isn't it? And for years, CTMS acted as a security trustee for mini bond schemes, which, just for clarity, are basically these high-risk, often unregulated debts sold to regular investors.
Yeah, very risky.
And also for QROPS pension transfers, those are the qualified recognized overseas pension schemes, letting UK savings go abroad.
Right.
So with that guardian role, it all sounds pretty reassuring initially, doesn't it?
It absolutely does. And that perception of reassurance is so important here. I mean, the role of a security trustee is, well, it's meant to be crucial.
Supposed to be, yeah.
They're meant to be the independent watchdogs, right?
Yeah.
Safeguarding assets, stepping in for investors if a scheme defaults. They hold the keys, basically.
Okay.
However, what our sources show, again and again, is that CTMS collected pretty hefty trustee fees, but, and this is critical, failed to act when defaults occurred.
Failed to act, so they just took the money and didn't do the job.
That's what the sources suggest. It's not just a small mistake. It's like a fundamental breakdown of their main job, leaving investors completely exposed.
That's the puzzle because, minimal oversight isn't just neutral. It creates an environment where things can go wrong.
Exactly. It's ripe for exploitation.
When the sources say CTMS, a firm its size, was like guarding Fort Knox with a single padlock, wow, that paints a picture.
It really does.
It shows how the so-called guardian could get deeply involved in the very schemes he was supposed to be overseeing, blurring those lines completely.
Right. The lack of tough regulation, plus Knight's own roles weaving in and out, it let his public image as this referee exist while behind the scenes something very different was happening.
So that light touch regulation idea, it's not always about efficiency, is it?
Not at all. It can create these huge vulnerabilities. It allows the people supposed to be providing oversight to get tangled up in the operations they're meant to watch.
The lines didn't just blur.
They pretty much dissolved.
Yeah.
And that just erodes the trust investors' place in these systems.
And Knight wasn't just passively operating within the system, he tried to shape it.
That's right.
Back in 2012, he was chairman of the Gibraltar Association of Pension Fund Administrators, and he launched a code of practice for QROPS providers.
I remember this.
This wasn't some quiet initiative. It was high profile, backed by government ministers. It promised to raise standards, keep out rogue operators, and make Gibraltar a beacon of pension integrity. He was literally pitching himself as the architect of a better system.
And for a little while, it seemed to work.
Really?
Yeah, the sources say pension transfers into Gibraltar surged. Knight was proudly saying Gibraltar was gaining traction, substantial funds coming in. He even predicted many more would follow.
So it looked like success.
It looked like it. It seemed like his reforms and the code were working. It painted this picture of a thriving, well-run sector.
But there's always a but, isn't there?
There usually is in these stories.
Yeah.
That promise, as the sources make brutally clear, didn't last.
What happened?
The documents state, When cracks appeared in the system, that celebrated code of conduct didn't evolve. It simply disappeared.
Disappeared. Just like that.
Poof, gone. This abandonment of standards, it's a really critical moment. It suggests maybe a willful disregard for the rules he himself promoted.
Like the rule book got thrown out when it wasn't convenient anymore.
That's certainly how it looks. It left the industry without the promised safeguards.
And that's the key insight, maybe. What happens when that safety net just vanishes?
Exactly. It creates this dangerous vacuum. The promise of integrity fades, and suddenly there's this massive vulnerability. Investors are exposed. It becomes fertile ground for dodgy schemes.
So the code vanishing meant that initial security was just an illusion.
Pretty much. It revealed this fundamental weakness that such a key safeguard could just evaporate without any real consequence. It's a stark reminder, isn't it?
Yeah.
A promise of integrity isn't the same as actual enforced integrity.
And it's right into that vacuum that companies like AWM Financial Solutions seem to have stepped. This is quite a revealing part of the story. AWM worked closely with the High Street Group Contact Center Limited. Their model was described as, well, alarmingly simple. Persuade pensioners to transfer savings offshore, wrap it in the language of wealth planning.
Sounds familiar.
And channel the money into a QROPS administered by CTMS. So, funneling money through Knight's company.
And here's where that conflict of interest really bites.
Oh, so?
Crucially, from those QROPS run by CTMS, the money circled back into High Street Group's loan notes.
Circled back.
Yeah, round it went. And CTMS was still the security trustee for those loan notes.
Wait, so the trustee's company is administering the pension, which invests in loan notes, for which the trustee's company is also the security trustee.
Precisely. That cyclical flow where the supposed protector is deeply embedded in the investment itself, that's a massive concern.
Yeah, that screams conflict of interest.
Absolutely. The insight here is clear. When a trustee isn't truly independent, when they're tied into the schemes they're meant to safeguard, their impartiality is just gone. They're essentially helping move money into investments that they or their buddies might benefit from. Classic red flag for any investor.
What's amazing is how early the warning started. By 2016, complaints about this AWM model were hitting the Financial Conduct Authority, the UK regulator.
Right, the FCA.
And the Financial Ombudsman Service, which handles consumer disputes. And they upheld cases of unsuitable advice.
So the alarms were ringing.
Loudly. Yet, despite these clear red flags, AWM's director, Tony Moran, he continued to appear in high street press releases even after his own bankruptcy in 2017.
After his own bankruptcy. Still promoting.
Yeah. It just shows this, I don't know, concerning lack of transparency or accountability. Like the warnings were just ignored.
And if you link that to the bigger picture, it really highlights a profound system failure. It's a crucial lesson for all of us, I think.
Which is?
Well, having a regulator uphold complaints isn't enough if the people involved can just carry on, seemingly without consequence.
Right.
When the High Street Group defaults started happening, CTMS's role as trustee looked, as the source says, more symbolic than protective.
Yeah.
It failed to provide that promised security.
So the system, initially praised for integrity,
had become this pipeline for high-risk investments, and the designated guardian just wasn't acting when it really counted. It exposes that huge gap between perceived protection and the actual lack of it.
As we dig deeper, it gets even more complex, almost deliberately obscured.
Yeah, the structures become quite intricate.
Our sources reveal that back in 2011, CTMS quietly set up a British Virgin Islands shell company, name Spellsteel Ltd.
Spellsteel, okay.
The description is stark. No trading, no staff, no clear purpose. Why would you set up a company like that in the BVI?
Well, that's the million-dollar question, isn't it? It should immediately set off alarm bells for anyone looking.
Because?
Because shell companies aren't just for, legitimate tax planning.
Yeah.
They're very often used to deliberately hide financial flows. Makes it almost impossible to trace who owns what or why money is moving.
Okay.
And sure enough, 2 years after it was created, Spellsteel pops up in a debenture deal with the resort group.
And Knight's connection.
Knight himself was a director at the resort group.
Oh.
The sources call Spellsteel just a name on a document ready to receive funds, even though it had no actual operations. It's a classic sign of an opaque structure, built for moving money, not for real business.
And it gets weirder. Spellsteel, this ghost company, it gets tangled in more deals. It even shows up as a supposed creditor in AWM Financial Solutions' Statement of Affairs.
The creditor owed money.
Yeah, listed as being owed £600,000. And guess what address they listed for Spellsteel?
Not the BVI anymore.
Nope. Cuthbert House, Gary Forrest's Newcastle base, remember him? Ran the High Street Group Contact Center.
Wow, so it all loops back again.
It's this dizzying web, interconnected entities designed, it seems, to obscure everything.
Absolutely. This complex web, especially involving a company with no operations but playing a big role in money movements. It's textbook how these offshore setups can create an illusion of legitimacy while masking, well, potentially dodgy activity.
Okay.
Spellsteel eventually got struck off the BVI register by 2017. You'd think that would be the end of it.
But its existence, however brief and shadowy, really highlights the dubious nature of these structures.
It does.
But in Knight's world, things didn't quite work like that. Fast forward to 2025, the Gibraltar Supreme Court hears evidence that another Knight-linked company,
Another one.
Castle Trust and Management Services, Jersey Limited, this one had supposedly been dissolved back in 2019.
Dissolved. Okay, so legally gone.
Right. But it had continued issuing invoices and receiving payments long after its dissolution.
What? How is that even possible?
That's what the court looked into. It wasn't just an oversight.
No, it sounds deliberate.
The documentation apparently showed payments, hundreds of thousands, flowing in during 2021 and 2022.
Years after it was dissolved.
Yeah. And the judge found the documents approving these payments bore Knight's signature. His explanations were called without foundation.
So not just bad paperwork.
The sources don't call it poor governance. They call it, quite bluntly, a misrepresentation of a dissolved company as still active.
Wow. That points to a deliberate effort to keep money flowing through a defunct entity. Raises huge questions about ethics, legality.
The brazenness of it, right?
Exactly. To keep that going for years after dissolution, that's something else.
And the real-world impact, the human cost of all this, it really hits home with the Dooley and Orrs case in the UK Court of Appeal.
Ah, yes, the Dooley case.
Yeah.
Very significant.
Here you had UK pensioners alleging their life savings, their secure pensions, were transferred into these costly offshore QROPS run by CTMS. And then the funds ended up in unregulated investments of little or no value.
Just gone.
For these people, it wasn't just a market dip. It was potentially devastating. Their retirement plans, their future security, just wiped out.
And the Dooley case identified a key link, didn't it?
Yes. Montague Smith, an unregulated intermediary based in Cyprus, described as close to Knight.
Unregulated. That's never a good sign.
He apparently referred pensions into CTMS for commission. Smith's company was later wound up, its director bankrupted.
So it points to this pattern, doesn't it? Unregulated intermediaries, driven by commission, funneling pension money into risky schemes, with CTMS right in the middle of the transfers.
The insight being
that the lure of high commissions can create these terrible incentives. They actively work against the best interests of the people trying to secure their future.
And the Court of Appeal, they didn't mince words, did they?
Not at all.
They described the whole thing unequivocally as a classic pension scam.
A classic pension scam.
Yeah.
That wording is incredibly powerful.
It's not just poor investments, it's alleged deliberate deceit. Exploiting trust, exploiting the desire for a secure retirement. The legal system saw through all the complex layers.
And that label, classic pension scam, it's so damning because it covers the whole life cycle, right? From persuading the pensioners to transfer right through to their savings, vanishing into these worthless investments.
Yeah.
It really underlines that these weren't just unlucky bets. They look like orchestrated efforts to siphon off funds under false pretenses. Huge, often irreversible consequences for the victims.
The universal lesson seems to be,
if it sounds too good to be true, especially with pension transfers and big commissions, it probably is. Be incredibly wary.
Now, to really get a handle on the scale of this, just think about this. Between 2013 and 2023, CTMS acted as security trustee for loan notes from a whole bunch of companies.
Yeah, the list is quite long.
Ridgemere Developments, Platinum Assets and Developments, Genesis One, 𝗪𝗵𝘁, High Street Group, the 79th Group, all under this one guardian, CTMS. That's a huge amount of responsibility.
The total value of the loan notes CTMS was supposed to be safeguarding. It was, well, staggering.
Yeah.
$422.5 million.
422 million.
Pounds, yeah. The sources put it powerfully. For a firm of CTMS's size, it was like guarding Fort Knox with a single padlock.
Wow. That's almost unbelievable. That much money with oversight described as minimal.
It's not just vulnerability. It's practically inviting disaster, isn't it? The key insight there is the sheer volume of assets under CTMS's supposed protection just dwarfed its actual capacity and the level of oversight. It created this massive systemic risk that, frankly, Regulators should have seen.
And here's the really crucial point for anyone thinking about offshore investments. People often assumed regulated in Gibraltar meant solid protection.
Right, that label carries weight.
But the results, as the sources show, suggest otherwise. Take Platinum Assets and Developments.
Okay, what happened there?
Despite clear red flags, missed payments, repeated investor complaints, CTMS apparently showed no evidence of enforcing security or recovering funds.
You sat there.
Loan note holders got silence or maybe vague assurances. Platinum became this textbook case of a trustee just failing to act. The regulated label meant nothing in practice.
And that is such a critical takeaway. Assuming regulation automatically means strong protection is dangerous, Platinum shows starkly. Even for flashing red lights and clear duties, the trustee can just become this inert entity. Collecting fees, sure, but offering zero defense when things go wrong.
Well, that's a lesson.
The word regulated by itself isn't enough comfort. It's the quality and the enforcement of that regulation that counts. You always have to dig deeper than the label.
Knight's personal fall didn't stop there either. He faced fraud charges in Gibraltar over allegedly misusing £50,000.
Right, although he pleaded not guilty and those specific charges were later dropped.
Correct. So that particular fight ended, but his troubles were far from over. It paints this picture of someone constantly battling legal issues.
Indeed. And then in August 2025, the Gibraltar Supreme Court dealt another blow. They threw out his attempt to set aside demands for payment, confirming he owed over £146,000.
And the court's view on his arguments?
They described the agreements he was relying on as shams, specifically designed to avoid tax and payment contributions.
Shams, so fake agreements.
That's the court's finding. It suggests this broader pattern, doesn't it? A disregard for financial rules that went beyond just the pension schemes, affecting his personal finances too. It looks like deliberate financial evasion.
And his network, the connections. They also started to unravel. Links to Belvedere Management, later exposed as a global Ponzi scheme.
Right, another red flag connection.
And the failed Blackmore bonds. But maybe the most telling twist was his longtime ally, Paul 𝗪𝗃.
Ah, 𝗪𝗃. What happened there?
After years working together, including, allegedly, schemes to hide assets during 𝗪𝗃's own divorce, 𝗪𝗃 actually turned on Knight.
Turned on him how?
He supported a bankruptcy petition against Knight.
Wow. After all that history.
Yeah, it's quite the betrayal, isn't it? Shows how frayed those alliances became, how quickly loyalty evaporates when the money runs out or the legal pressure mounts.
So this combination, the legal battles, the alliances breaking, it all led to the final outcome.
Yeah.
On July 8th, 2025, Stephen Knight was declared bankrupt by the High Court in London. His estate is now managed by trustees from Grant Thornton UK.
So bankruptcy, the end of the line operationally speaking.
It seems so.
Yeah.
The finality of it triggered partly by a former close associate. It really closes the chapter on this figure who held so much sway in that offshore pension world.
It shows even the most complex networks, the tightest alliances, they can just completely fall apart under financial and legal stress.
Absolutely.
So wrapping this up, what does this all mean for you, our listener? We've traced this journey of Stephen Knight from positioning himself as a guardian of integrity, navigating this maze of regulations, shell companies, high-risk investments, and ultimately leading to huge investor losses and his own bankruptcy.
Yeah, from reformer to bankrupt.
Quite the fall, not just for him, but for so many caught up in it.
And this deep dive into the sources, it really hammers home how vital it is to understand the true role, the actual actions of those you entrust with your money.
That gap between the advertised protection and what actually happens.
It can be enormous. It's a powerful reminder that even environments labeled regulated can have serious weaknesses. Due diligence can't just stop at reading the label.
You really have to look under the hood.
You absolutely do. Question independence, understand the mechanics, ask the hard questions.
So what stands out to you from this journey? From reformer to receiver, think about all those layers, the financial setups, the crucial trustee role that often wasn't fulfilled.
And the devastating results when that role is compromised.
It leaves us with a pretty compelling, maybe unsettling question, doesn't it? How can any of us truly protect our financial future when the very systems designed to safeguard it can become so complex, so opaque, and, as alleged here, so easily manipulated?
It's a tough question.
Hopefully this deep dive helps you navigate those complexities with a bit more awareness.
Disclaimer. Insolvency and Law Limited is not a firm of solicitors or licensed insolvency practitioners.
We do not conduct any regulated legal or financial activities as defined under the Legal Services Act 2007 or the Financial Services and Markets Act 2000. We do not offer legal advice, financial advice, debt counselling, or conduct litigation. All blogs, podcasts, reports, and other published content by Insolvency and Law are provided solely for general information and educational purposes. They should not be interpreted as a substitute for regulated or professional advice and must not be relied upon as such. For matters that require regulated legal or financial advice, we recommend seeking guidance from an appropriately authorised and regulated professional.